Hey guys, welcome to another Ultimate Edge webinar series, this time with Merritt. So before we go into kind of the deeper level of this though, Merritt, for those people who are uninitiated and don't know what a reverse mortgage is, can you just give us the basics of what a reverse mortgage is, what's it about?
Yeah, a reverse mortgage is a mortgage. Right out of the chute, it's a mortgage. It's borrowed money that allows a senior, 62 and older, and sometimes a little younger in some cases, the ability to monetize a portion of the dormant equity in their primary residence for their use today while they're still alive with no payment. The part of the reverse mortgage that freaks people out or that gets them thinking about strange things is it doesn't require a payment. So how can that be? Well, simply the interest is accruing up in the cloud. And when the last person living in the home leaves permanently or dies, the estate has about 6 to 12 months to repay the reverse mortgage. 9 times out of 10, that's a sale of the property and paying off the reverse mortgage with interest, and the rest of the equity goes to the estate. Simple.
Okay, so it's a mortgage that doesn't require any payments. Typically, you got to be 62 years of old or older, but you mentioned possibly younger. Explain that, please, for those people who aren't aware of that.
Yeah, some 62-year-olds have a younger spouse. And in the olden days, that younger spouse would not be on the reverse mortgage. And if the older spouse passed away, that person's going to have to sell the property and pay off the reverse. It's not a good solution. So now the FHA has kind of redone the rules, and they'll allow a younger spouse, younger than 62, to be on the reverse. So if the older spouse passes away, the younger spouse has every right to stay in the house, and it doesn't require repayment until that person dies.
How is the mortgage amount calculated, Merritt? How much do you know how to lend?
Yeah, it's calculated. It's like an insurance product. So everybody has a life expectancy, and the reverse mortgage is trying to figure out how long people are going to live, the borrowers that are showing up asking for reverse mortgages. So a 62-year-old is going to live longer than a 90-year-old. So a 62-year-old will get less of a reverse mortgage, a lower loan to value, than a person 90 years old will get 75% loan to values, because they're not going to live long. There doesn't need to be as much equity in the property to withstand that interest rate accrual. And so it's based on the age of the youngest borrower. And then there's a calculation that's done, an algorithm that's used, and it comes up with the HUD approved amounts. So,
and is there a general rule of thumb for the younger people for reverse mortgages? Let's say you're 62, 63, 65 years old, and you want to do a reverse mortgage. What percentage of the home can you borrow, Merritt?
That's just under 50%. And a 94-year-old will get 75%.
Okay, good enough. And so there's two people, they're married, they got on a reverse mortgage, one of them passes away, what happens?
Nothing. Everything stays the same.
Okay.
When the last person dies or leaves the home permanently, like to a hospice, they're not going to make it, the estate has 12 months to pay off the reverse mortgage. And that's done. The heirs normally don't want to live in mom and dad's house. They have homes and families of their own. They just want the money. So the estate sells the property.
Okay, so
that doesn't want problems. They grant extensions. I've seen them go years.
Now, let's clarify something here, Merritt. You just mentioned HUD. So what is the acronym we use in the industry is HECM, and I would tell you that most people don't know what the heck a HECM is. So what is that, and how is HUD involved in all of that?
Well, HECM means Home Equity Conversion Mortgage, and it's just another name for a reverse mortgage. And HUD is a part of the federal government that administers housing programs, some of them for seniors, like the reverse mortgage. So HUD, a federal government agency, wrote the rules for a reverse mortgage in 1978, a number of ways.
Okay, so HUD steps in and they insure this mortgage. Is that what's going on?
They provide the insurance for this mortgage in case the loan is upside down and there's a loss. That means the reverse mortgage balance is higher than the value of the property. That loss does not go back to the estate. It's a funny word called wend its way back to the estate. Nope. HUD eats that loss, and the insurance that they purchase and that the borrower purchased too goes to pay for that policies. So this is called, in technical jargon, in reverse mortgage talk, a non-recourse loan. So there's recourse back to the estate. So It's heads I win, tails HUD loses.
So one of the questions we get, Merritt, is how expensive reverse mortgages are. Can you speak to that, please? Where's the expense and just how expensive are they?
Well, a reverse mortgage, like any other mortgage, has third-party expenses, title, escrow, appraisals, and that is as normal as any other mortgage. The only difference, which increases the price or the cost, is the insurance we were just talking about, the HUD insurance. And if my notes tell me right here, it is 2% upfront that gets kind of put into the mortgage, and then there's 0.5% that's calculated annually, which as the interest accrues in the cloud, a little bit of that premium accrues in the cloud. Nobody's paying this out of pocket, but these are the premiums that are financed.
Let's move this forward to the myths about reverse mortgage. You and I kicked this around a little bit. So one of the myths that you already debunked is when they die, the government comes and seizes the home and takes the assets of the heirs and all that stuff. Not true.
Well, it's just a sneaky way for the bank or the government to steal my home. No. They're going to throw your spouse out of the house when you die. They're going to steal your equity. I've heard them all. And normally kind of the genesis of these urban myths is there's no payment. So people fantasize. They start making up things in their head to justify no payment. Well, if I'm not going to make a payment, they're just going to take my equity. They just make things up. This is a normal mortgage. The only wrinkle is the payments and the interest accrue up in the cloud. And everybody knows what up in the cloud means, I hope. Maybe you can explain that, but cyberspace, they're accruing in spreadsheets at the investor, the interest that's accruing. And when the last person dies, the house is paid off, the house is sold, the mortgage is paid off with interest, and everybody goes their merry way.
All right, so let me just say what I think Merritt said here, just one way of looking at this. So up in the cloud, the lender is going to keep track of the interest that accrues on a monthly and annual basis on this loan. It accrues over time. There's no payments. So eventually the interest has to be paid. And when the last homeowner moves out or passes on, then HUD or the lender at that time has the ability to take the house and sell it and pay back. Or if there is equity, the estate has the ability to sell the home and pay off the reverse mortgage with all of that accrued interest, which is the up in the cloud interest that Merritt's talking about here. If there's any equity left over, the estate gets it. If there's no equity left over, the estate's no worse for the wear. It's just a done deal.
Right.
Yeah.
The parameters of the reverse are designed such that all things being equal, without a crisis, without some terrible crisis, it's some crisis, there will always be equity left in the property. That is the desire. That's how these mathematical calculations have been formed.
Okay. So now there's fixed rate reverse mortgages and variable rate, and there's a line of credit component and all of that. Can you explain the differences there, what's about, and if it makes much difference one way or the other?
Well, it can. You can't get a line of credit if you have a fixed rate reverse mortgage.
Okay.
Normally we see fixed rates for purchases because you can use a reverse mortgage to purchase a property.
Uh-huh.
Yeah, and people want a fixed rate. They've got it in their head, and good for them, and we can offer them a fixed rate. But if they want kind of extended benefits like a line of credit or 10-year payments, little payments that are made to them, you have to have an adjustable program. Those didn't exist, about 3.5 years ago. These are kind of new products, but they're far, far better for the client. And the line of credit is amazing. It is a growing line of credit. It's incredible the benefit. The unused portion of the reverse mortgage, the unused portion of the line of credit grows every year by between 4 and 5.5%. Incredible benefit. And it's designed that way, HUD, in their infinite wisdom, and I didn't say that tongue in cheek, but they don't want the senior to have to refinance all the time. So this growing line of credit is they're addressing that issue. It's not perfect. It doesn't maybe appreciate as much or lose as much, quite frankly, but that's their stab at it anyway.
So how much does it grow each year, Merritt?
Between 4 and 4.5 and 5.5%. Just depends on the terms. And we determine those right up front for you. But that's.
And it grows no matter what the value of the real estate does. Is that correct?
No matter what the real estate does, that unused portion of the line of credit grows by that amount. Another wrinkle of the line of credit is it can never be curtailed. It can't be taken away.
Hey, Merritt, so what about you're a snowbird? You're living in the home, you maybe a couple, maybe one of you, whatever the situation might be. Can you leave the home? Can you move out for a while? And how long can you stay out of the home?
Well, it's typical owner occupancy requirements of a forward transaction. So it's 6 months and a day. You've got to be the primary resident. You got to own it. It's not for second homes. But you have the right to go visit the kids for 3, 4, 5 months. It's no big deal. Nobody cares about that. HUD wants it to be owner occupied for obvious reasons. Owners take care of their collateral better than renters. And I know a lot of great renters that doesn't apply to, right? But on average, the analysis that they've done says that they want it to be owner occupied. So owner occupied primary residence, all those rules apply.
Line of credit, you haven't used that portion of the line of credit. Is interest accruing?
On a HECM, it does. And on a jumbo, it doesn't quite yet. And most jumbos are fixed rate jumbos, and you cannot get a line of credit. You only get a lump sum of cash. Now, California, that's different. California, the investors have a different analysis of California. You can get a line of credit in California, but most other states, you cannot. All the other states, you can't get a line of credit. It's only a fixed rate lump sum of cash on the jumbo program.
Okay. So that's why it's accruing.
Right.
Now explain though, on the HECM with a line of credit, interest is accruing on what's been borrowed, but not what has been not used yet. Correct?
So for instance, they get a $100,000 line of credit and they decide to pay off their minivan, $10,000. They have $90,000 untapped in their line of credit. It's growing. That available balance is growing every year so that they can have access to 92, 94, whatever the interest rate calculation is.
But the interest that's being charged on the HECM is only applied to the amount that they've borrowed so far.
Correct.
Tell us about the jumbo product. What's different and what's it used for and all of that, please.
Well, the jumbo product primarily is it allows the financing of a much more valuable piece of property with a higher value, higher price. So a HECM in Hawaii, the maximum value considered to run the numbers is about $780,000. And then from that valuation, the HECM is created, which means maybe a $450,000 HECM is about the biggest one you can get. Not all, but with a jumbo, it goes all the way up to valuations of $10 million. And the loan amount, the largest loan amount you can get is about $4 million. So it's completely different realm of values that the jumbo reverse mortgage allows.
Okay, so what about the expense? Are they a lot more expensive than HECM, the jumbo, or how would you put it?
There's no insurance premium, so they're not more expensive. There is an origination fee that goes to the lender. We're the broker on it that we don't receive. And on many of the HECMs, there's no origination fee. But we have creative ways of adjusting that. Just depends on the structure. We try to put together the very best reverse mortgage for the client. Number one, is kind of a hierarchy of decisions that have to be made. Number one decision is, what's the very best for the client? Not what's best for the loan officer, not what's best for Bay. It's what's perfect for the borrower. How can we get that dialed in? That is the number one priority.
Let's move to strategy. So
Okay.
There were 3 strategies. You and I talked about them prior to the call, if you remember what they are. Why would somebody want a reverse mortgage? Strategically speaking, how are they benefit somebody as a financial tool?
Okay. Well, I think the number one reason is to reposition existing debt that's requiring more payments, credit cards, cars, and existing mortgage. I would say 85% of all, or 80% now of all, borrowers show up with debt. And this reverse mortgage is a tool to reposition the debt and not have a mortgage payment or any other payment on that debt anymore. So it increases their cash flow.
Okay, so reposition debt means use the reverse mortgage to pay off other non-real estate related debt like the car and the boat, the credit card.
You can also pay off an existing mortgage.
And the mortgage, exactly, right.
We have existing mortgages, and if the equity is there, we pay off. The most The most common thing that we pay off is a mortgage. And so from a financial perspective, that might lower the portfolio withdrawal risk. If they can reposition debt and increase their cash flow, maybe the senior won't tap into their portfolio, which comes with huge financial obligations if they do it. Sometimes they're deferred taxes and the federal government takes a big, huge bite. So that maybe that will help them do that. And I'm not a financial planner. I'm not giving financial advice. And we should always advise our senior clients to get good quality financial advice.
Absolutely.
Another one that kind of dovetails into it, we call a portfolio shock absorber. So they can use a line of credit to help offset maybe some losses their portfolio is taking if there's a perturbation event like we've seen in the market. Another one is, to right size. A lot of seniors, they have a 4 bedroom home with 3.5 baths, and they don't want to, have to go into debt to buy something else. And a reverse for purchase, HECM for purchase, allows them to use a reverse mortgage to buy a home that's the right size for them, it's not full of deferred maintenance. The property taxes might be different. It might be in a senior community, whatever. And it allows them to right size and maybe reduce some of their expenses. Let's see, the last one is, this one's interesting from a financial perspective, is to delay taking Social Security. So we know that if you take Social Security at 62 or you take Social Security at 70, you get different amounts, right? You get a lot more. It's called grossing it up. I think that's the term for it. And the reverse mortgage line of credit might help you cover some expenses while you defer taking Social Security so you can gross it up.
Now, let's speak to the purchase again. What's the mechanics of using a reverse mortgage to buy a home? Is it different than a regular mortgage or what?
No, it's the structures of them are different, but you're using proceeds from a mortgage to help you buy a property. The difference is, on a traditional forward mortgage, you have a payment. With a reverse mortgage, you don't. Let's just assume it's a 62-year-old buying a $100,000 house, just to keep it real simple. And we know, based on our previous discussion, that a 62-year-old can get a reverse at about 50% loan to value. So you have a $100,000 house. Your reverse mortgage will cover $50,000 of that purchase, and then you bring in the $50,000 in cash to close. So there's your reverse for purchase. So it allows the senior to keep half of her money or his money and still buy the house with no payment, as if they paid all the money. So it's cash is king, husbanding resources. And the reason seniors pay cash for property is because they don't want a mortgage payment. Well, if we can show them how to pay half the cash.
Oh, is the money taxed by IRS as income? That's a good question. What are the tax consequences of having a reverse mortgage, Merritt?
There are none. Now put your regular forward mortgage hat on for a second. When you refinance your home, and everybody has a PhD in forward mortgage refinancing, because everybody's financialized, they've done it 5 times. The debt that you pull out in cash, is the IRS going to tax debt? No, they're going to tax income. Even though they don't define income, we kind of have an idea that they don't define debt as income. And so it's not a taxable event.
There you go. And can you write off the interest expense?
If you're not paying it out of your pocket, you cannot write it off. You have to have an expense to write it off. So as it's accruing up in the cloud, you're not realizing that accrual until the loan is paid off. Then you can write the interest off.
Merritt, it's been great. I don't see any more questions that popped in right now. Anything else you want to tell us about reverse mortgages? Anything at all we haven't talked about?
Yes, I think that it's important to point out that we have a huge bubble of baby boomers that are retiring, 10,000 a day. And increasingly, since I started fiddling around with reverse mortgages, they're less and less prepared to retire. They've utilized debt a lot. They haven't saved enough. And the debt, the equity in their home is really the only untapped equity that they have to increase the quality of their lives today. Mortgage is the only way to get at it. So it's a great tool, and it's increasingly in demand, and it's a wonderful, you can feel good about it. We get letters and cards from seniors that we've helped all over the country, and we've saved their homes. We've increased the quality of their lives because they don't have a $1,200 a month mortgage payment now. and it's beautiful. You don't see that on the forward side. Plus, the demographic, working with seniors, these are wonderful people. And it's great to have a product that we can offer that we can feel great about.
Okay, you know, that brings up a really basic question I should have asked at the very beginning. Let's say you have really bad credit because you've been struggling and so on and all that. What does it take to qualify for a reverse mortgage besides just your age?
Yeah, there didn't used to be any qualification, but there are now. There's no minimum credit score required, but you can't be ready to go into tax foreclosure on your home. So we look at the credit, and it's very minimum. The bar is low, but you can't be in tax default, and we can't normally rescue the person out of a property tax default like we used to be able to do. So maybe they've been late once or twice. We can still do the reverse mortgage, but there are new financial assessment guidelines that do create a financial review. But compared to a forward mortgage, it's a very low bar.
Okay, so what happens if we determine they don't have enough income to pay taxes and insurance? What happens then?
Well, we'll use some of the proceeds to set up this thing called a set aside so that the payments can be made out of this set aside, which are some of the proceeds of the reverse mortgage. It's just like an impound account, but they fund it up front. The way HUD has noodled it, thought about it, come up with a solution is this income set aside that funds the tax payments for a period of time, because we don't want seniors to go in tax default. And as we're originating these, you know, it's important that we communicate to the senior that you still own the property. You're on title. This is yours. You have to maintain it. You can't let a meteorite come through the roof and not fix it. You can't let it get flooded and not fix it. You can't let the windows stay broken, and you have to pay your property taxes. Now, we can discuss how fair, you know, school property taxes are for seniors. You know, that's a different argument, but the government, the state and local government's going to charge it, and if they don't pay it, they're going to lose the property.
All right, guys. So you got to pay the taxes, pay the insurance, and maintain the property. That's basically.
Right. Oh, and what property types? Single family.
Oh, yeah.
A HUD-approved condo for a HECM, 2-unit, 3-unit, and 4-unit owner-occupied.
No manufactured homes?
We can do them. HUD hates them because, and I have a lot of friends that work at HUD because they just don't believe the collateral is as secure, but we do them. The guidelines say you can. It has to be HUD-approved. It has to be about a 1994 unit and newer. It has to be common for the area. The appraisal has to have manufactured homes in it. So, you know, those are the parameters. Now, with the jumbo, the condo does not have to be HUD approved.
Guys, I would normally give you the other panelists' phone number and contact info, but don't contact Merritt when you want a reverse mortgage. Talk to the loan officer who can help you with it. Merritt runs the division. He's the vice president of the whole thing. He helps us when we need it, but we rarely have to talk to him because he's got a great crew, by the way.
Yes.
Merritt, thanks, man. I appreciate it.
Thank you. Look forward to talking to you again.